welcome everyone officially to this very special event. As I mentioned, we are recording this. It'll be available in the resources. Questions. So please do ask questions all throughout this session. Use a capital Q and a colon when you put them in the chat, and we will do our best to make sure that the presenters see them. Because this is going to be an excellent presentation, this expert hour. On behalf of the fourth floor, today's topic is the other funding option with Lighter Capital. So our presenters are here from Lighter Capital, and I'm really excited to introduce them. Before I do that, just a very brief word about the fourth floor for those of you that don't know about the fourth floor, although looking at the attendees here, I think most of you do. Some of you might not. For those of you that don't know, we are a market network that is designed to diversify boardrooms and cap tables, and we are on a mission to close the gender, wealth, power, and funding gap by advancing for-profit board careers for women, by supporting women-led startups and funds, and by providing women with opportunities to invest in other women. So that is what we are all about. If you are not a member of the fourth floor, then, and you're a founder of a startup, please consider joining us so that you can leverage all of the tools and the incredible candidate base that we've assembled to find expert advisors, directors, observers, mentor sponsors for your advisory and governing boards. Also, we have a job board where you can look for talent, and we have a back room where you can seek funding. If you are a woman-led or BIPOC-led venture, we want to help you get funded. If you are an individual and you are interested in advancing your for-profit board career, or you're curious about investing, maybe you're already an angel investor, maybe you're LP curious, whatever your interests might be, we have a spot for you at the fourth floor on the other side of the marketplace as a board candidate or as an investor or both. So please consider joining us. There is a discount code if you are not currently a member, but you are here at this session today. So congratulations. It is LIGHTER25. We'll drop it in the chat. LIGHTER 25. So if, for a first time purchase of a membership, it'll give you a discount. Love to have you join us. And if you have an employer who you think might be interested in covering the cost, you can also reach out to us because we are here to help make that easy for you, and we would love to do that. And then last bit of housekeeping before I introduce our wonderful speakers is just, we do platform tours every single Monday from 12 to 12:30. So even if you are part of the fourth floor already, but you're not completely familiar with our new platform, definitely recommend that you swing by, come to a platform tour. If you're new to the fourth floor, it's a great way just to learn what we're all about and figure out if it makes sense for you. There is a board boot camp as well coming up on February 1st from noon to 2. We do them like every 6 weeks. They are incredibly valuable to just get an overview of, not just the fourth floor, but more importantly, how to build out a board as a founder and how to really become a board candidate and step into that role. On the candidate side, we have lots of templates, lots of material. It's really valuable. So encourage you to sign up for those things, which we'll drop in the chat. And that's enough about me and about the fourth floor. So now, without further ado, it is my absolute pleasure to welcome to the spotlight, and then I'll be exiting the spotlight, but to welcome to the spotlight your presenters today. So we have Melissa Widner. She is the CEO of Lighter Capital. And Lighter Capital, for those of you that don't know, it is the pioneer and the leader in revenue-based financing for tech startups and scale-ups. Lighter Capital is backed by National Australia Bank, Silicon Valley Bank, and Voyager Capital. Melissa herself has a deep understanding of both the entrepreneur's journey and the role that a funding partner can provide, because Melissa, as a CEO, led a couple of companies through successful exits. She had over a 10x return to her investors. So I'm sure your investors loved you. It's very impressive. Congratulations. She was the founder and CEO of Silicon Valley-based 7 Software, for those of you that may have heard of it. She was also managing director of NAB Ventures, which is the VC arm of the National Australia Bank. And she is the co-founder and chairperson of Sydney-based Heads Over Heels, which is an organization that supports women entrepreneurs running companies with high growth potential, which is very, very cool. Wonderful. So welcome, Melissa. So happy to have you here. And she is also joined by Jamie Loy, who is Investment Director at Lighter Capital. Jamie currently works in the investment team at Lighter Capital. She has been in the startup ecosystem for over a decade. She is a former founder herself. She is also an investor, and she is a woman in tech and finance. Formerly, she was a Wall Street executive with over 20 years of experience. So really incredibly impressive, both of you, and just so excited to benefit from this incredible expert hour. So let me now turn the stage over to the two of you. You should hopefully both be pinned to the spotlight here, and let's get started.
Thanks, Breen. It's so great to be here presenting to women. We do a lot of these, and still the majority of our audience is men when it comes to startups, especially tech startups. So this is wonderful to be here to talk about what we do at Lighter Capital. So I'm going to let Jamie start us off, and then I'll go into some of the details, and then Jamie will wrap it up.
Absolutely.
Okay.
So the one thing I like to share that I think we didn't share with Breen, but from my personal view, when I would introduce Melissa, I also say she's the most fun and fabulous CEO that I know.
Thanks, Jamie.
The word in tech and in finance, but we're also fun people. So Lighter Capital, here's our company overview. We offer non-dilutive funding to companies. We were founded in 2010. So I really do believe that we are the pioneer and leader in lending to early stage tech companies based on a product that we're known for called revenue-based financing. So for 12 years, we've been working and partnering with founders, offering them capital financing and also community support, introduction to the ecosystem, at the same time allowing them to maintain equity in their company. So to date, we've deployed over $300 million in $300 million. We've worked with over 500 companies and have funded over 1,000 rounds of transactions. So that tells you our company, we have a lot of repeat customers that actually come back to come and get additional rounds of financing from us. As Breen has shared, our investors and partners in the ecosystem are also very notable. Credit Suisse, Silicon Valley Bank, I-80 Group, Voyager Capital, and the National Australia Bank.
Thanks, Jamie. Oops. We already talked about our background. So I'll talk a little bit about why there's this need, or why Lighter Capital was created over a decade ago. So as Breen said in the introduction, I spent a long time, the better part of 2 decades in venture capital, both in the US and in Australia. And as a venture capitalist, you're basically in the rejection business. So you say no to 98.9 companies for every one you say yes to. And a lot of those companies, most of them, in fact, are really good companies. So venture capital backed companies get all the publicity. It's what we read about, it's what we hear about, but that's the reality is it's a very small percentage of companies that will qualify for venture funding or want venture funding. It's it's not for every growth company out there. And then there are the banks in terms of a source of funding, and banks typically won't lend to companies that aren't profitable, companies that don't have hard assets, where the founder isn't going to give a personal guarantee. So Lighter was formed to provide capital to companies that couldn't either didn't want to or couldn't get it from venture and wouldn't be able to get it from banks. So we're very much aligned with the company's growth. It's a very easy process. We'll talk about that a little bit later, but our application takes 10 minutes if you're a slow typer. Can usually get a term sheet within a few days and funding within a few weeks. We have our credit decisioning is made purely based on data. So when I was a venture capitalist, the big thing every venture capitalist will tell you is that they're looking at the team. They're really backing a team. And the problem with that is that that's a subjective measurement. And there's a lot of unconscious bias that goes into deciding what teams to back. And a lot of pattern recognition. And I think probably everybody on this call knows, what that leads to. So at Lighter, not surprisingly, if we look at the companies that we've backed over the last decade, 40% have either a female founder, co-founder, or senior female, or a female as a senior member of the management team, which is much higher than venture-backed. And we don't look for that, we don't seek that, but when you're making decisions based purely on data and the team doesn't come into it, then that's just what happens. What does revenue-based financing look like? Jamie will go into a little bit more, but it's pretty simple compared to going out and getting a venture round or even an angel round where you have to have, dozens, maybe hundreds of conversations, but there's no financial covenants. The value that we bring, Jamie will talk about more in terms of the community, can be high or low, but some of our customers choose not to access those opportunities that we have. We don't take board seats. There's, we are there to provide funding and then help if and when the companies need it. We already talked about the timing, but the timing is one of the big benefits to the entrepreneurs, that they can get funding really quickly, so they're not spending time out fundraising versus building their businesses. We have two products. Our main product is our revenue-based financing, and I'm going to dig in a little bit to that. We also just have a standard term loan, which is a term loan with fixed monthly payments that it's typically 3 years long. If companies want it for a shorter period of time, for a year or 2 years, we're happy to do that all day long. Usually our customers want longer periods, longer time to pay back their loans, so their monthly payments are lower. But I'll dig into what the revenue-based financing option looks like. So essentially, we provide a certain amount of money, we'll call it $1, and depending on the length of the loan, most companies want longer payback periods. So most of our payback periods are over 3 years. The payback will be set at the beginning, and it'll be based on the risk profile of the company, but it's usually somewhere between $1.30 and $1.35. Could be lower for really low risk companies or higher for high risk companies, but it's fixed. So we would say, Jamie, I like your business. You fit our credit profile. We'll give you $1. And over the next 3 years, you're going to pay us back $1.30. And you're going to pay us a fixed percentage of your revenue until that $1.30 is paid back. And it's cash collected revenue. So it might be, depending on how we've modeled it, it might be 5%. It's usually under 10%. Say, Jamie, pay us back 5% of your cash collected revenue until you've paid back that $1.35. And we are $1.30. And we model for the funds to be paid back in 3 years based on our prediction of a company's revenue. If a company grows faster, we don't get paid back more, but we get paid back faster, which is great for us because that's a higher IRR. If a company grows slower, we have a lower IRR. If they go out of business, we might lose our principal loan. And the nice thing for the company side, I've, like Breen said in the intro, I ran a couple companies and founded a company, and the payments are based on cash collected revenue. So, and it's a low percentage of the monthly cash collected revenue. So if you're a company with seasonal revenues, we have a lot of companies in the ed tech space that might have collections twice a year. You don't have an onerous debt payment for those months when you don't have cash coming in. And it also provides downside protection. So we had some companies that got hit really hard during COVID. We had one that was in the lunch delivery space for corporates. So you can imagine what happened to their business. Their revenues were down 90% when COVID hit, but the amount they paid us was down 90% as well, because it's a percentage of their cash collected revenue. We also had a ticketing company that provides the ticketing infrastructure for events, and their revenue model was to get a clip of the ticket. So you can imagine what happened when COVID hit for that company. They were on a rocket ship pre-COVID, had to scale way back during COVID, and now they're on that rocket ship again. But the nice thing with our product was they didn't have a big debt burden to service. Whereas, if they did, they may not even have been able to scale back and survive, the really downtime. So it provides some downside protection for companies. And usually people have a lot of questions on the structure of this, so go ahead and put those in the chat. We'll probably go through them at the end. That might be the easiest way to do this, but happy to take any questions on how this works. Companies take capital from us for a variety of reasons, but probably, the same reason that companies would take venture capital or angel financing. And by the way, oftentimes we are funding along with angels and along with venture capitalists, or after venture capitalists have funded, or more often before venture capitalists have funded a company. We'll get more into that. But mostly companies are looking for our capital in order to fuel growth. So they're, we fund all kinds of stages, but the typical company that comes to us has about $1 million in revenue, somewhere between 1 and 2 million in annual revenue. And now they're ready to put on a few more salespeople or hire some more devs, build another product, but they have a very specific need for that capital. Sometimes, and we're seeing this more often now, it's used to buy out a partner, or potentially a founder who's been working at the business for a long time to get some liquidity for the founder. But our capital, it's used for all the ways that startups would use, venture capital or angel capital. Where we fit. So we get asked this a lot, and primarily, Jamie will go into the minimum criteria, but primarily this is sort of the seed stage. Companies have to have revenue. So it's usually a seed stage, what you would think of sort of seed, post-seed, where we would come in. But that said, with 1,000 rounds of financing, we have funded companies who've taken multiple rounds from us and never gone on to take venture money or any dilutive equity. And we've also had companies, especially in this market with down rounds, who are already venture backed, still doing well, but they maybe took their last round from venture capitalists into a year ago when valuations were a lot higher. They need more growth capital. They don't want to go out and potentially do a down round or a flat round. So we're seeing a lot of companies that are already venture backed coming to us. But the most common is probably a company who's raised a little bit of money from friends and family, and they're now ready to take some growth money. This just talks about where they've come through or where our customers have come from, how they've been funded prior to Lighter, and the majority were bootstrapped. This just gives an idea of some of the companies that we funded, and as Jamie mentioned in her when she was speaking earlier, we have a lot of companies that have taken multiple rounds from us and have just decided that this is the way to get funded. Once they're in the Lighter capital portfolio, accessing additional capital is usually a matter of a couple of days. And as companies grow and their revenue grows, they can access more capital. Companies tend to follow one of three paths. Either they're bootstrapped, they use our capital and just grow with it and remain bootstrapped all the way, meaning they're not taking external funding. They go on to become VC backed. We have a company I'll talk about later that's a big example of that. Or they go on to become acquired. A lot of these examples, not all of them, but a lot of them were ones that never took external funding and then went on to be acquired. So, the founders and the employees owned 100% of the business when it was acquired. And this just talks a little bit, gives some examples a little bit more. These are some more recent examples, but I'll pick out a few. So Flip is actually a Brooklyn-based company that was formerly called Red Route. And they did a couple rounds of financing with Lighter. When they started with us, they had $1 million in revenue, and they used our money to grow to $3 million in revenue. And then they were ready to do a venture round. So we actually helped them. We gave them some feedback on their deck. We made introductions to venture capitalists for them. And they raised a venture round about a year ago from a great VC. And now they're just off to the races. DBT Labs, that's a Philadelphia-based company. They took early on, they took a $240,000 round from us. They got a lot of traction on the product side with that $240,000. Excuse me, they went on and raised $5 million from Andreessen Horowitz, then $30 million from Sequoia, and then they went on to become a unicorn. So we have that story over and over again. As Jamie said, we've done over 1,000 rounds of financing to 500 companies. So it's really about helping companies get to the next stage without taking any dilution and giving up any ownership. We're in Canada, Australia, and the US. We've been in the US since its inception and launched Australia and Canada just about a couple of years ago. I'll go into some more customer examples because I think this is the best way to really explain how our product works. So Bonnie Crater is the CEO of a company called Full Circle Insights. It's a marketing technology company. And she talks about she has this incredible background. She was the VP of marketing or had senior marketing roles at lots of large companies in the Valley. She saw a need for a product and went out to get money in the early part of the last decade and wasn't able to raise any venture financing. So she came to Lidar in 2013. She had revenue at the time. We provided her with her first loan. Then she went on to get venture capital. And then subsequently, she's come back and done 2 more rounds of financing with Lidar Capital. And all the while, she's growing her business and has been growing it every year. Map Anything is a company that did 5 rounds of financing with Lidar Capital, and then they went on to raise money from some large venture capital firms, and then they were acquired by Salesforce. Seamless AI is a great example of using Lidar Capital's money to grow and get to another value, a higher valuation. Brandon and Danielle, it's a husband and wife team. They took over $2 million from Lidar and 2 rounds of financing. And they grew their revenues from when they first came in, they were actually under 4 million in annual recurring revenue. And they grew their revenues with our money with non-dilutive capital to over 20 million in revenue. So, and then they went on to do a large private equity round where the founders were able to take some money off the table. But, Brandon gets up, he comes to our CEO summits and says that he's personally worth hundreds of millions of dollars more because he took this non-dilutive funding, from that 3 million to 20 million in revenue stage instead of taking dilutive funding at that time. This is just a little example of the effects of a dilution at exit. I won't go into it in detail, but you can map out what happens at an exit if you didn't take dilution in terms of the return to the founder and to the early investors if you didn't take dilution, especially at the early stages of a company when it's most expensive to give away equity. But that will be up in the chat or that will be posted on the Fourth Floor site for people to dig into. And I'm going to now let Jamie talk a little bit about what Lidar offers on the more than money side. We provide companies with funding, but we also provide them with a lot more to help them grow their businesses.
Yeah, thank you, Melissa. So, I hope, I didn't know if you noticed, while Melissa was going through the examples of companies that took funding from us, she actually knows them fairly well. So our company is just very relational. So yes, while we understand, as Melissa's a former founder, I'm a former founder, we do understand capital is very important, but the other thing equally as important is the support, right? Is community support, making introduction, and however, anything that's outside of money that can be done to support you in your business, Lidar Capital does that. So part of it is we really have built a Lidar Capital community. The photo you saw before was from our most recent CEO summit. Once a year, we bring together CEOs of our portfolio company, and over 2.5 days, the CEOs go through shared learnings, advice, just pure support, right? We talk about what they share, challenges that they go through, some of their mistakes, what are the best things that they've done, just other resources that they refer to when they have challenges. So it was my first time attending the Lidar Summit CEO, and I will say that I wish personally, as a founder, as a former founder, I wish I had a resource like that, because it's invaluable, right? You have so many people that are literally going through the same journey you are, and it doesn't have to be the same. So you could meet someone from a similar industry, but it's just in general about leading a team, about being the founder, right? So we recognize that equally important to capital is the support in the ecosystem. So we have annual summits. So that's once a year. The other thing we have that I think is also very important is CEO groups. We have an amazing person, Caitlin Getz. She heads up all of our partnerships. And she curates monthly CEO groups. And the CEO groups ranges between maybe 8 to 10 CEOs. And she'll match CEOs up in a combination of maybe industry, the size of your company, some of the challenges you might be going through. So those have been very, very successful. And I think this year we're forming actually even more CEO groups because at a certain point, we like to keep them intimate. So at a certain point, the size of it may not be, if it gets too large, may not be as effective. And once you've come together, you've engaged in a group, we actually offer, we put together a private Slack channel so you all can keep the conversation going, right? We're happy to facilitate that so that you're able to do so. And then on top of that, we certainly have partnerships and perks. As Breen mentioned at the top of the hour, for all of Lighter's portfolio company, if they're interested in joining the fourth floor, we have a partnership with the fourth floor. So Lighter's portfolio company can join a fourth floor at a discount. And our most widely used perk is actually credits with AWS. Through us, there's actually $25,000 worth of credits with AWS. So this is just another example. Michaela Wesso, her company Style Arcade essentially is a smart fashion tech, but a very similar story where she came to us with either two or three rounds of funding. She grew her annual revenue from 1 million to about 3 or 4 million, and then ultimately went on to raise a very healthy VC round. So what are the type of companies, what are the qualifications that we look for, right? So as you know, we're revenue-based financing. We take a percent, the repayment to Lighter Capital is a % of your revenue. So we look for companies that have at least 200,000 in annual recurring revenue. That comes out to be about 15,000 monthly recurring revenue. And for the moment, we can only work with companies in the US, Canada, or Australia. We like to see that you need to be in the business for at least 1 year, because then that gives us 1 year of financials to look at. We also like companies with low customer concentration. So we like to see customers with diverse customers as well. And of course, we want to see high retentions of those customers, so low churn. Having a healthy gross margin is also important to us. So we typically like to see about 50%. And we generally work with tech-enabled companies. There are exceptions on a case-by-case basis, because I like to share with people that we really care about predictability and reliability of revenue. And for business models, the tech sector just fits into that easier. And then lastly, we like to see companies with at least 6 months of revenue. And who is not a right fit? What are companies, what are the characteristics are not a right fit for Lighter Capital? So if at the moment you're pre-revenue, so for example, if you are post-product, but you're pre-revenue, what I say to companies is that at this time, you're just a bit too early for you. I'm happy to still take a call to explain how we work with company and what revenue-based financing is. And I'll say to you, I'll touch base with you in 6 months. Additionally, if your immediate cash needs is greater than 4 to 6 times your MRR, we're probably not a good fit. So if you only qualify for, say, 100,000 from Lighter Capital, but you're seeking 1 million or more, it may not be, we may not be of interest to you. We've said you needed to be located in US, Canada, Australia. If you have, again, high customer concentration is a concern for us. If you do not have any recurring revenue, that's going to be a challenge for us, just because we make a prediction that you can pay us back in 3 years. So if you do not have recurring revenue, that's going to be a bit of a challenge for us. And if you have really low gross margin, again, it might be, if that's just your business model, we will not be a good fit for you. But if that's just in the short term and you're working on improving your margin, so what I would say to that is, again, you're a bit too early. I'm happy to walk you through how we work with companies and what our other qualifications are. And I'm happy to talk to you in a few months. we mentioned this fantastic partnership with the fourth floor. We're very happy to have gotten to know Breen and Kat. So yeah, and we're looking forward to continue this partnership for our portfolio companies and introducing them to the fourth floor. Thank you very much for tuning in with Melissa and myself. If you have any questions, please apply to visit lightercapital.com to apply, or reach out to me. You have my email in the chat. It's jmoy@lightercapital.com. And we're happy to take some live questions.
Amazing. That was so fascinating, and just really what a wonderful model to hear all about it and understand it. I think I saw a lot of comments in the chat along those lines, and definitely we echo that sentiment. There were a handful of questions that I captured that I just thought maybe I would just run by you guys just to make sure that you saw them. So there was one question about asking if you have any social or environmental impact commitments that include lower fees or different repayment obligations for benefit or impact organizations. And there was also a follow-up question along those lines. And I actually think this question came from Alana. So if you want to take over, Alana, I don't need to ask the question for you. But just in case, I just thought I would do it to be helpful. The follow-up question was, how otherwise do you incorporate impact considerations into your offering or into your firm?
Thank you so much for highlighting those questions. I really appreciate it. I believe that Jamie answered the first one directly, namely that because they are alternative and non-dilutive funding, that they're looking more at revenue streams and less at the organization style, registration type, or impact goals of a firm. But I am also curious, at the SheMark, part of our impact commitment is to look further into all of the companies that we work with. And so I'd like to hear a little bit about what impact operations or considerations you've built into your firm, and how I am super appreciative, not just of your statistics regarding female founders at companies that you work with, but also female leadership. I think that was super insightful. And as we all know, the vast majority of women don't engage with firms from an ownership or a foundation perspective or space. They really do come in at entry level and try to work their way past that broken rung and get promoted. So I really appreciate you including that in there. And I'd like to hear a little bit about how you've built that into your firm and what other sort of intentional operations you have that target social impact.
Yeah, so that is a great question. And it's an area, like we talked about in the beginning, where Jamie and I have spent a lot of our volunteer time and free time around, and primarily around gender. And when I started Heads Over Heels, and I think that's when Jamie really got involved in angel investing a little over a decade ago, I had been a venture capitalist at that point for 10 years. And I'd had 2 successful exits as a CEO. And I had hardly even had a woman pitch me. So it wasn't just that we weren't funding women, women weren't even pitching me. So there was something wrong, and it hadn't been changing at all. This was 2010, and I'd seen literally no change in a decade. So we started Heads Over Heels with a few other women. This is in Australia. And it was designed, when I thought about the success I had with my business, it had to do with connections that I had, or introductions, important introductions at the time that were made for me. And I could trace almost everything good that happened with Seven Software to, I got the right introduction at the right time. So we started it with, women are in general less connected than men in terms of connections that are important for growing a business. So connections to financing sources, connections to strategic partnerships. So what Heads Over Heels does is we have our what we call our connectors, and they're senior business leaders, men and women, who are willing to open up their networks to our portfolio of female entrepreneurs. So that's just a little bit of background in terms of how we think about this. When I first came into Lighter Capital, I was on their board for a few years before I became the CEO. I wanted to look at what is going on the gender side, because it looked to me like we fund a lot more female-led companies than I funded as a VC, or I saw VCs funding. And sure enough, like the stat I shared earlier, that was the case. And it's because we're not looking at team at all. We're just looking at numbers. So in terms of a conscious effort, what I'm primarily focused on, what we're primarily focused on is just getting the word out to women that this is available as a funding source. You don't have to go down that standard path. That is more difficult for women. It's getting a lot easier over the last decade because there's been a spotlight put on, firms that don't hire women and firms that don't fund women. So that's, measuring it is making it better. Finally, we're seeing some progress, although it's slow. But what we're trying to do is just get the word out that this exists as a funding alternative. And then also to highlight, these women that are running companies, because one of the issues that one of the big issues I think that exists for women is, that you can't be what you can't see. And if you don't see women starting and growing large companies, you don't even think of it as a path. So that's how we're focused on it. Ilana, thank you for asking that question.
Thank you for your response. I appreciate that that's very much a part of how you do business and your operations considerations.
And if anyone else has questions, I know there were a couple of other questions, but I actually think, Jamie, you've done such an excellent job answering them in the chat. You may have already spoken to them, one related to the perks, which I think you answered. The question about CEO meetings for founders who do not yet qualify or like a little bit too early for your funding. I think you kind of answered it. I'm not sure if you directly answered that question. So maybe you could speak a little bit more about, what should the founders listening who are a little too early, what should they be thinking about, and where can they go for a resource, if not to you?
Yeah. So I'm part of actually 2 CEO groups now, and I find that invaluable. I actually pay a lot of money to belong to those CEO groups, but Lighter offers this for free to its customers. And it is just so valuable. It's a lonely job running a company. You have to always have that positive face, and where do you go when you need to just sort of let down? I think that's one of the biggest benefits we bring, that Lighter Capital brings, is just that connection to other founders who are a lot of times, at the same business stage. But in terms of companies that don't qualify yet, well, there's the 4th floor. That's a good connection place. I realize the focus is more on boards, but make sure, find your tribe, find others that you can bounce ideas off of. It's so important when you're in that role in the early stages. It's something that when I founded 7 Software, I had through an organization in the Silicon Valley called Forum for Women Entrepreneurs, but it wasn't a specific CEO group. And I wish I had had that. I really did miss that in both the companies that I was running. It would have been very valuable for me to have that group. So I would say, go out and find it. I realize I'm not giving you any specific names, but there's so many organizations devoted to helping startups now that just get out there and form your own group.
And the one thing I like to add, like if you, based on the qualifications that we shared and, what are the requirements Lighter looks for. And if you think, this is one of those things where women, I think, are guilty of, like they see a job description and if they don't meet all the qualifications, they don't apply. But men that meet maybe just half, they still apply, right? So if you looked at the qualification and you feel maybe you're not all there, what I would say is reach out. Because we're always happy to have a 30-minute conversation. We're happy to go through your financials. And I think what one thing that what I've learned, especially in this environment where it's kind of uncertain and is not as generous as 3 years ago, right? So financial health of a company is just very important, right? Managing your numbers, your cash flow. And until I joined Lighter Capital, I wasn't as dialed in as I am now. When I look at a company's P&L and balance sheet, I see completely different things. Had I had this information of Lighter Capital's requirement, I would have run companies and advised my companies completely differently. So in this environment, what I tell a lot of companies, right? So Melissa mentioned the awareness, getting the word out, is exactly what we have been doing. So I say to companies, if you, in your cash flows, if you have 12 months runway, it's good. It's not great. I would start thinking about how to even extend that. If you have 6 months, which is what Lighter Capital likes to see, you should light some fire under your feet and really go seek, like, pay attention and how to extend your runway. And it's a very different philosophy when we're not in an uncertain market and if you're just VC backed, right? Because you're just burning cash. So I would say if you feel like you might be a good fit, but maybe your number is not entirely there, reach out. I have other colleagues in the investment team, and I'm sure all of us, whether it's me or someone else, would be happy to kind of take 30 minutes to walk you through.
We usually get a lot of questions just on the structure of the financing, but I'm assuming maybe that we answered all of those in the deck if there's no questions.
Everyone's a revenue-based finance expert now. And was there any questions in the chat that I missed? Please let me know. If I missed, it's just not intentional. It was just, I just missed it. Was everyone's question got answered?
Perhaps maybe you want to drop your email, or maybe you did already, your contact information in case it pops into mind after the event. I know sometimes it takes a minute to process.
I'm dropping both of our emails right now.
Great.
I'd love to ask a question about sort of at what stage of financing you prefer to work with firms. Obviously, as revenue-based financing, you're focusing more on sales and what's coming into or licenses, I guess, depending on where your revenue comes from and what's coming into a firm. But some of the examples that you gave were from firms that had already raised pre-seed, seed, or even maybe just a friends and family round. So I guess as individuals, as a firm, do you prefer to work with companies that have raised some money in the past that maybe have existing financial obligations to repay or to bring profit for existing shareholders? Or do you prefer to be on the side of, let's get this initial financing in and then we can introduce you to a venture network, for example?
Well, I just realized in the deck, we don't even talk about our size of financing. We fund between 50,000 as our smallest loan up to $4 million. So, and the average starting size is about 450, but we'll fund as little as 50 and as high as 4 million. But to answer your question, we don't necessarily have a preference. If a company meets our underwriting criteria, which we talked about before, at least 200,000 in ARR, they've been in business for a year, they've got a bunch of customers, and we don't like to see only one or two customers, because if they lose one or two customers, it would be hard for them to pay us back, because we're paid back based on a percentage of revenue. But we love to see equity support. We think because that mitigates some risk, but most of the companies that come to us when they first take funding from Lighter, they don't have equity support. They've been bootstrapped, as we saw in that one chart. I don't know if you remember, but 55% of the companies, when we initially fund them, they've been bootstrapped. So they have no equity support other than the sweat equity that the founder has put in.